The Hedgeless Horseman here again. Second video of today. Last one I did a rant on Bitcoin. First of all, thanks to the sponsors. I thought I would go through some concepts of investing concepts, and it's like mistakes and how you can, what an edge is, or it's like common edges, like let's say that you can employ in your strategy, investing strategy, to basically take advantage of how the market operates. My titles are pretty poor, but let's look at a few here. So it's like, okay, optionality. We know Pierre Lassonde said that the market has a very hard time pricing optionality. And he's also said that if you give me free optionality, I'll make you a millionaire. What he means by that is, in the case, for example, that it goes to his royalty deals. I mean, Franco Nevada, which has done fantastic. I mean, the idea, what he's talking about is that if he buys something for fair value, a known quantity, a mine, he buys a royalty on a mine, a royalty on that production, let's say. But he also gets a royalty on any future production that's not yet been discovered, let's say. So he buys a royalty on a mine that sits in a large land package, and it's a project-wide royalty. And he pays fair value for the actual mining operation, that cash flow. So he's making sure that he's getting his money back from the known mine, but he's not paying for any additional success. If they find a second deposit or a satellite deposit or an even bigger deposit within that land package, he's gonna get all that for free because he did not pay for it. That's one thing that's like, I try to remind myself of that all the time. It's like, look for as much optionality as I can. And that's why, there's nothing that is risk-free. I mean, even with a royalty, for example, if he pays fair value for a mine that's in operation, something bad could happen with the mine. So it's like, at face value, it's still free optionality. And maybe, they do a bunch of due diligence. It's like, this mine, probably nothing bad is going to happen here, and they will actually get their money back and then get a free option and everything else. But that's one key thing, especially, I mean, when you hear smart people say that, and it's like, and if you again think about it, it's like, what is free optionality? That's risk-free upside. If I pay fair value, that's why I love the margin of safety plus alpha plays. I mean, that's why, as many people would know, it's like why I love, for example, First Nordic. Because in my mind, the current market cap is not even reflecting the value of the known Barsele deposit. If we just look at face value, 45% of what's the intrinsic value of Barsele? I mean, if it would be up and running today, it'd probably be 2 billion. But let's cut it down to 1 billion. I mean, it's not hard for a mine today, a decent mine even, to be worth $1 billion at today's gold prices if it was operating today. Okay, so we're conservative. $1 billion, because that's not a run-of-the-mill mine. That's expected to be very low cost and have 150 to 200,000 ounces per year production profile. That's not a lot of mines that can do that in a tier 1 jurisdiction. Again, tier 1 jurisdiction adds a lot because, like, the security of tenure, it's like nobody's going to steal it from you. So it's like that bird in the hand is going to be your bird in the hand. And it's very much, I mean, from a permitting standpoint, there's no such thing as a guarantee, but it's like very, very high chance of getting permitted thanks to, all the work by Agnico, and that Sweden is going pro mining. So it's like, it's basically as solid as a margin of safety and tangible value as you can get without it actually being a mine in production. But again, if it would be in production, it would probably be valued at around $2 billion, given how you, especially with the land package, given the other sales that's been going by 200,000 ounce producing mines that are actually old and stale and deep and whatever, and they're not really that low cost as I would think Barsele would be. But let's say 1.5 billion, just to be a bit conservative. And then we add further to the fact that, okay, it's not up in operation yet, so we reduce it by $500 million. So we're down at $1 billion, like as basically as tangible, especially since we accounted for the risk, let's say. So it's like, in our minds, that's worth $1 billion. That project, Barsele alone, is worth $1 billion, okay? 45% of that, what's that? 450 million. What is Barsele First Nordic selling for? I don't know, 150 million or something. So it's like 200% under, or it should go up 200% to be, quote, fair value, just based on what's already known. It's like if I were Franco-Nevada Pierre Lassonde, I'm buying a cash flow stream worth $3 for $1. That's not fair value, that's undervalued. And if that is undervalued, means by default then I'm not paying for anything else. I'm getting Ojärvi for free, I'm getting all the exploration potential for free. And it's not only a royalty, I'm getting 100% interest. So it's not like, especially given the amount of targets they have, it's not like, oh, if you find another 1,000,000 ounces just at the Ida discovery, for example, you'll get 5% of that. No, I'll get 100% of that. And that alone could be worth, I mean, they have so many targets, that's like, you never know, they could find 1-2 Barseles, but I'm not paying for it. So that's at face value, because yes, obviously you have to drill to actually discover it. But it's like, it's cheap drilling, they have, what do they have, $12 million or something, so they'll be able to test some stuff. And it's like, even if you account for dilution, doesn't matter much. If you add, whatever, increase the market cap of 50 million, accounting for dilution to drill 50 million worth of targets, that's still not pricing in 45% of a conservative value for Barsele. So all intents and purposes, from my, a risk-reward perspective, all the exploration potential is risk-free. Because they cannot drill a target that makes Barsele go down in value. It's only upside risk. I hope you know what I mean. At face value, that's only upside risk. So if I can find stories where it's like, okay, I'm buying it for 200% less than it's worth, that somebody probably will pay for it someday. Now it's obviously the Agnico interest that's basically blocking any acquirer to come in, right now at least. But that alone, if I find something that has tangible monetizable value of 200% higher, that's like, whoa, give me that. If I can see a high probability of getting 200% returns on my money, you would be happy to wait for years to get that kind of return, right? It's that good. It's like, what, 3 years is nothing if you can get 200%. If we're really, rational about it, because the market average is what, 9-10% per year over the long term. So already there you have like, hey, I could make a case on this just based on Barsele. Then what separates that from another story? Imagine you only, Barsele Minerals, one could say, only had the Barsele project and only had Barsele, even though the Barsele project has a lot of targets as well. But it's like, I cannot even, I think people don't appreciate how much of a different case this is. Because let's pretend that there's no other target, and let's pretend that there's the ounces at Risberget, for example, which I think Agnico has an internal resource for already. It's like, forget about all that. Just look at the current super conservative resource. If I could only buy that for 150 million, I would be stealing, which I think we are. But then add 100 kilometers of strike, 9, I don't know how many targets we're up to, like, let's say 8-9 targets, 100% owned targets. Some of them are very, very large. You could fit a Barsele, you could fit Ikkari, whatever. that changes the long-term risk reward immensely, obviously, because if they drill all those targets, I'm not risking First Nordic to be overvalued depending on the outcome of those campaigns, right? If they miss on every single target, find absolutely not a single ounce, I'm still expecting to get my 200% from the Barsele value alone. And that's, pretty conservative at this gold price, right? So in a sense, it's like, the Sun Tzu, put yourself in a position where it's impossible to lose, because then the only option is to win. And again, this is at face value. There's always something that can happen. I'm not all in First Nordic. I just have a very large exposure to it because the quality of the margin of safety plus some of the highest free exploration upside of any gold junior. That combination is so unique that it's hard to, compare it to, I don't know, some other mature developer. Take Skeena Resource. I don't know what that's up to. Maybe a 1.5 billion or something. If they get that up and running, everything goes okay, yada, yada, yada. Maybe you'll get a double from that. And that's assuming a mine up there with quite complicated metallurgy. That's what I've heard at least. If everything goes well, let's say you can get a double on that. They don't have that much of a land package. They don't have any, as far as I know, obvious big upside targets beyond that, and they're already at 1.5 billion. So for them to, it's like, okay, if things go well, I'll get a double. I'm not assuming that gold and silver just keeps going up or whatever. So this is just an theoretical example. If I'm assuming they need to execute and I'll get a double, there's no obvious free optionality beyond that. And if there is, it's hard to have it be material relative to the current price I'm paying of 1.5 billion, right? If they find something worth 1.5 billion in addition, then I can get 200%. That's not a small feat to find something that's worth an additional 1.5 billion. So compare that to First Nordic, where in my mind it's like, it's a simple project, tier 1 jurisdiction, probably gonna get built, low cost. So I'm convinced it's worth at least $1 billion. So the current stake is worth 450 million. And I think somebody would pay $1 billion for it, let's say, is assuming. We can also do the other exercise. Okay, assume 50% dilution to get it 100%, and then somebody pays us $1 billion. That's why that would be such a big catalyst, because then somebody can actually acquire it. But anyway, let's stick to the basics. If I'm seeing 200% up to conservative value, and before they, let's say, if they try to build it themselves, yes, rubber is hitting the road. But I'm pretty sure that somebody would be willing to pay that. It's like someday that's going to shine through that value, and they don't even need to ask any real questions. They don't need to find the money and build a mine, because somebody's going to pay for that. Because it's actually, if it was in production, would be worth much more than $1 billion on a 100% basis. And I get 8-9 targets plus a project in Finland, which I think is the highest grade gold resource of any junior in Finland. If I get that for free, compare the risk reward between Skeena and First Nordic. I'm not saying Skeena is a sell. I'm saying if we're talking risk reward and optionality, let's say, quote, risk-free upside, I don't think they even compare. And that free upside, since the targets are so large that you could theoretically find new multi-million ounce deposits, compared to the current market cap of 150 million, a new Barsele would be $1 billion. And that's conservatively speaking. That's going to take some time to, prove up, of course, but still. that has huge implications to the current market cap. Whereas if Skina finds something worth $1 billion, you're buying it at 1.5 billion. So even if there is a $1 billion target, it's like, yeah, okay, 67% upside, the potential that you get for free. Whereas like, oh, if First Nordic finds something similar, that's 100% of additional upside that you didn't even pay for and thus took no risk on. Insane. That's why I keep saying it's like there's a lot of stuff that's cheap. One could argue Skina is cheap. I'm not after what's cheap. I'm after the absolute best risk reward I can find in the entire space. Because in the long run, that's going to matter a lot. Anyway, going to the next one. One asset target project focus. The market has, and again, optionality, the reason for this is that the market has a hard time pricing it in. Do you think any success is priced in for any of the exploration targets? No, because for First Nordic, no, because it's not even pricing in the value of Barsele. So it's, as per Pierre, can have a very hard time at pricing in optionality as it should. Okay, I'm abusing that. Okay, I'm taking advantage of that. So I'm getting risk-free upside. One asset target project focus. The market can only really focus on one thing at one point in time. Where it be a target, a project. I mean, as soon as the Landins have a company that gets a second asset that's good, and it's not, they're not trying to put it into production. It's like non-cash flowing asset. In this case, I'm thinking of NGX, which spun out Philo Mining. Because they had, we have a development asset. We found a new one. This company is not in the plan of actually becoming a mining company. So then there is the market one thing the market can focus on, and they tend to do that with, let's say, the Barricks and the Newmonts. They can look at cash flow. That's one thing, right? So if you're trying to build a producer, if you add a bunch of future cash flowing assets and you're not getting much credit for it, if you can still, let's say, if you have access to capital, or even better, if you can self-fund it, then it doesn't really matter. Because if you get nothing for it now, but you can build it without massive dilution because you're so cheap based on the sum of its parts, that added cash flow from the projects that's not being priced in right now is going to hit the same balance sheet, the same cash flow statement as the flagship asset that you're now getting priced in the market. And then the market is going to reprice that. Because if the cash flow grows by 2 times, you can expect that the market cap will at least go up 2 times, right? So that makes sense. That's one thing to also take advantage of. And there's caveats to that, because there's juniors out there with, let's say, 6 projects. They have one flagship project, they don't have much money. They're not doing much work, but they're doing some work at the flagship project. But the other assets are, let's say, very early stage. They can't really show, they can't monetize it. It's like they could theoretically spin them out, but it would not amount to much because it's so early stage, whatever. So it's like you can't see, it's like I don't see how they could really monetize it. Because they don't have enough money to actually work these projects and potentially punish the market for not pricing in the potential, because you're not testing the potential. And you can't, it's not again a cash flowing asset that's going to hit the cash flow statement one day. Then you have basically, in a sense, a value trap, because there is nothing per se that will force the market to give, even if those additional 4 projects on top of the flagship project, even if they are worth something, the market tends to focus on one thing. And if you're not even working it, there is no threat of one of those 4 other projects shocking the market in terms of, Well, we made a discovery here. Now that's the new flagship project, and it's actually worth more than the first flagship project. Plus, if that happens, if you can do that, then it's going to pick that as the flagship project, and then it's going to decrease the value you get for the first flagship project. So it's like a whack-a-mole of sorts. If you're able to actually work the other projects and have the threat of reward. Otherwise, it's theoretically just a value sink. Because again, at face value, the market can just keep ignoring those assets if there's no threat of monetization in a sense. Nothing that forces the market to care about it. If you have, and I'm going to go through a few later on, if you have several projects, and I could name like Ridgeline, Inflection Resources, First Nordic, they have multiple projects, multiple targets. They're not getting value for all those projects and targets. They might get value for one target, one project. Then the beauty is that, well, okay, if it's pricing in, even if you take fair value, like high risk, high reward situation, okay, it's discounted, risk adjusted, but I'm paying for one project, one target. And let's say 5 targets from each company are going to get tested. There's 5 different threat avenues in terms of reward. You need one to make it work. But the company's priced and accounting for the risk adjusted value of one. So whatever the market is pricing in, whatever project it's focusing on, you're paying for that. If that is successful, you're going to get the reward. Sure, it's pricing in some, but it's not, let's say, pricing in a 90% chance of success. It might be pricing in a 5% chance of success, if it's a pure exploration story. First Nordic is different because you literally get every target for free because the margin of safety, there is something there, and it's worth a lot more. So that's a risk-free exploration. But the higher risk, higher reward cases, which I like, Ridgeline and Inflection, they don't have necessarily margin of safety. So it's not from a necessarily value. They're cheap on a risk-adjusted basis, but it's not free value. It's not like they don't need to do anything more, and I'm still expecting this to get revalued higher. No, they have potential. And some of that should be reflected, of course. And in those cases, I think only one of their projects is reflected in the risk reward. So if we assume they have 5 projects to work, you're paying for one, you would get, you're buying the 4 peripheral projects free of charge. But there's something priced in. So in case one project or target works out, yes, you paid, let's say, 25 million. That's where you start with. And if they end up becoming worth 300 million, you'll get the difference, right? But when you have 5 different threats, not only does it diversify the case from an upside perspective, because if you only need one, it's pricing in one. So if you have 5 avenues to make a company maker, you get 5 shots, and you only need one to work out for a really good return because it's just priced like they have one. It's not like, oh, they're priced at 100 million, accounting for the fact that they have 5 shots. So in case of one working out and it goes to 300, you're getting a 200% return. No, it's pricing in just one product, not pricing in the threat of monetization from the other ones. So you get kind of the full benefit of a one target company in terms of pricing, but you get the diversification upside potential like it was 5 juniors in one, all with one target each. And you only need one to work out, so you have 5 shots, and you also have the benefit that there's a possibility that not only one will work, but 2, 3, 4, up to 5. So cumulatively, you have the upside of 5 juniors, but you're paying for one. And it's diversified on the upside that you have 1/5 of a junior in terms of risk, because a single asset target junior has one shot and that needs to work. But you have 5 shots in these cases. So from a, whatever, okay, let's say your case was, I'm gonna hold one of these juniors, let's say, quote, high risk, high reward juniors, until they've tested all these targets. Compare that to, I'm gonna hodl this one asset, one target junior. They have one targeted test. If that misses, it's over. If that works, you'll make money. Compare that to hodling a high risk, high reward case and letting it play out, meaning you wait for all the 5 different shots to play out. The risk reward difference is monumental. Up to 5 times the upside, in a sense, even though, again, even if they make 3 discoveries, you're not going to get priced for 3 individually, then you might need to do the Lundin way to spin it out. So there's some more work to be done to monetize that. But still, at face value, assuming you can spin it out, whatever, you get 5 juniors worth of upside. You're diversified across 5 different projects. Only need one of those to work out. The risk reward is not even close. Much less risk, even though it might still be high risk. But instead of, if you take, let's see, I'm just gonna pull up a calculator on my phone. Let's say there's 5% chance of success. If you're hodling a 1 target case, there's 95% chance of failure. If they have 5 targets with 5% success chance each, the chance of failure goes from 95% to 0.95 times 0.95 times 0.95 times 0.95 times 0.95, 77%. And that's assuming a 5%. So instead of 95% chance of success, 5% chance of success, you're looking at 23% chance of success, with the option that 1, 2, 3, 4, up to 5 can be successes. So that's almost a 23% chance of success for the 5-pronged exploration hydra versus 5%. 23 divided by 5, 4.6 times more likely to succeed. 4.6, or 360%. If we're just talking risk. 360% less risky, even though it's high risk at 77% chance of failure. So not only 360% lower risk via diversification across 5 projects, but you also have the upside of 5 different juniors. So think about it. It's like a multiplier. It's insane. Oh, this is 360% less risky, even though it's a high risk, high reward case. Not only that, but you get up to 5 juniors worth, single asset, single target juniors worth of upside. And if you're paying almost the same price, imagine what that does. I almost get chills. Imagine how that changes the risk reward. It's absolutely monumental. It's obscenely how different those cases are from a risk reward perspective. Imagine you could find 10 of those. So you're actually diversified. It's like, okay, 23% chance of risk of failure. So you almost would almost need to own 5 to have, quote, 1 work out. Imagine you had 10. So you're almost, in a sense, statistically speaking, making sure you're diversified enough, and that, let's say, at least 2 will work out. And if they're cheap enough and the price is big enough, those 2 might have, whatever, long term, like 10, 20x potential. then you're gonna make money from that high risk, high reward strategy. You could also, of course, you have, let's say, 10 juniors with those high risk, but if they're one asset, one target companies, that's just a 5% chance of success. So you're expected to have half a success story out of 10 stories. So you need to go up to 20 similar sized positions to make sure, statistically speaking, you get one success. And then that have to pay for 19. It's not even close. It's not even close. Stuff like this, again, investing, risk reward, risk adjusted value, investing theory, speculation theory. When you hear about it and think about it, it's like these are absolutely monumentally huge concepts that almost nobody thinks about. And I mean, to me, it obviously helps that I have a poker background where you had to think about risk reward and odds and statistics. So I mean, those portfolios would not be even close. If you have 10 different 10 high risk reward stories with 5 projects each 5 targets each, compared to somebody else who also has 10 high risk, high reward stories, but they only have one target. At face value, it might, let's say they're all valued at 25 million market cap, and they all have a, whatever, $500 million potential. So at face value, it might look like, oh, if you have 2 portfolios with 10 of each type of stories in, you think they're even remotely close from a risk reward perspective. They are not even remotely close. One is expected to have 2 successes, one is expected to have half a success. And that half a success have to pay for 9 stories, where those 2 successes have to pay for 8. And it's actually 2.3 success cases statistically compared to half. So it's what? Over 4 times more likely, or 4 times more success cases in one, plus those 4 success cases only need to pay for 8 other failures before it becomes a free roll, whereas that half a success case needs to pay for 9. And statistically, it's a 50-50 chance if you're gonna get 1. I mean, these are big concepts. All of this adds up. That's how I think when I'm looking at risk reward situation. That's why inflection, for example, is my largest pre-discovery story. I'm not saying it's, and that doesn't mean I'm all in inflection. It's just that I actually have a few percent of my portfolio instead of the average, which would be 0.3% or something like that. If I knew inflection were gonna hit, I would have much more. If I knew I was gonna get a 20-30 bagger from inflection, I would obviously have more. If I could find 20 different inflection resources stories, I would have, I could make a portfolio just 20 inflection resources, 5% each, and I think that portfolio would absolutely kill it, just from, quote, high risk, high reward exploration. Because statistically, I think it's so diversified and the prices are large enough and the stock is cheap enough. But in any given case, I don't know what the chance of success is. I hope that makes sense. It's like, I think, again, this is important stuff. And that really is, this is how I think you should think when we're talking position sizing and what's actual risk reward and what's tangible risk reward. Because people a lot of people think they're even remotely the same in terms of risk reward. Oh, it's a high risk, high reward case, and then you have another high risk, high reward case, and then it's like, oh, you're not getting paid for, Ridgeline is another example. It's like, okay, you have 7 projects, whatever, you're going to be testing 4 of them or something, and 3 by majors. And it's like, yes, okay, it's you're frustrated that it's not getting priced in, but that is also the beauty of it. But compare that to Ridgeline, where they had 7 projects, but they're only going to be testing 1. Then it doesn't really matter that much, because there's no threat of the reward side happening on the other 3 that you're not paying for. Insane difference, especially from a company perspective, because yes, if you give them 5 years, maybe they'll test all. But if you can test all within 1 year, that's obviously much, much better, because in 1 year you get the threat of revaluation, monetization from 4 projects, and yet you only paid for 1, instead of, okay, it takes me 5 years to distill or whatever, to capture the risk reward mistake, but the higher than abnormal risk reward, because the market has a hard time pricing in more than 1 project. If it takes you 10 years versus a case where you capture that but it takes you 1 year, from a compounding perspective, obviously that's also an insane difference. So it's like every single one of these concepts add up. That's why it's like, it's not about knowing the future. I don't know what stock is going to do best. I don't know what target is going to hit. I don't know what target is going to miss. I don't know what company is going to do best. But if we have the thinking correct, you're going to make money simply because you're playing the odds in a good way, and you're taking advantage of all the things that the market has a hard time doing. It's having a hard time rationally pricing in optionality. It's having a hard time pricing in multi-asset juniors. And of course, again, going one step further, it's not enough that they have multiple assets. What really makes the difference is, okay, how many have threat of getting monetized? And then you can go even further if you have 2 identical stories. Like, okay, if this one can test all those targets in 1 year versus the other one, you can play out the discovery story across 2 years. I mean, then the 1 year case is obviously much better. Because if it is a favorable risk reward situation and you can find 20 juniors like that, you're going to have the answers in 1 year, and then you can find and assuming it's like, okay, on the expected value of this portfolio is 50%, oh, then I'm expected to get 50% this year, whereas like the other portfolio that takes 2 years with the 2-year case, that's 50% over 2 years. Huge compounding difference. Extremely short time frame. Yeah, I mean, this is what I think I've talked about before. This is very applicable, prudent, I was going to say. So, time to expected positive news release. So here's like time, okay, when it's, even if, let's say there's an obvious news release, everybody knows it, everybody's expecting it to be positive, or it's like when you think about it, yes, of course it's going to be positive, or at least it's going to add value, whatever. If it's too long out, nobody cares. Nobody cares, because everybody, especially in the day of crypto, there's always a meme coin out there that could go up 100% today or 1,000%. Why? Even if you think this news release from this cheap price is gonna add 50%, or it's whatever, you're buying something cheap. Oh, it's worth $3, but it's selling for $1, and this news release is gonna add 50% or $0.5 to the intrinsic value. So it goes from buying something worth $3 for $1, you're buying something $3.5 in whatever 6 months for $1 today. That's still not exciting enough, because the stock is cheap because it's boring. Nobody wants to buy it if it's not going up. And nobody cares about a news release that's 6 months out, even if it's obvious that it's gonna, it's worth 50% of what you're paying for it today. That's just how it is. Is that rational? No, 50. If you can get a 50% return theoretically every 6 months, you're gonna be richer than Warren Buffett within, I don't know. I mean, the compounding is just obscene if you could compound it 50% per 6 months. But that's too boring for people because there's something always out there that can go up 100% tomorrow. That you can obviously abuse, but then you have to, okay, how do you abuse that? Well, you have to figure out what news you expect to come out from the company. If I buy a company I have no idea about, I don't have any clue what the news releases are going to be 6+ months from now, or even 3+ months from now, then, I mean, you're not taking advantage of anything, right? And especially, let's say, oh, there's a junior that they have no money, they have no obvious potentially positive catalyst, whatever, then there's nothing to take advantage of, really. I mean, it might be a super boring stock, so you might play the sentiment swing, or you know what I mean. Or, I mean, might be a stock where it's like, okay, we know they have a good project, the market is not right there yet to fund this, but I'm just gonna sit on this until the sentiment changes. Then they're gonna get money. Then it's gonna they can have threat of monetization, threat of actually drilling, and this superb or obvious project, whatever it might be. Yeah, that's a case in itself. It's like built on patience. That's basically it. Patience arbitrage. Getting paid to wait. I mean, that's probably one of the biggest and easiest things to do. It's like you're just I mean, I have a few like examples. I mean, if you have the classic one is the Lassonde curve, right? A company starts construction. Oh, this mine should be up and running in 2 years, and they're fully funded, let's say. So it's like, well, if gold prices stay here, when this mine is in production, it's gonna be worth 2-3 times what the market cap is now. Then people are gonna look at that, it's like, oh my god, 2 years? I can find something that goes up 200% next month. I've seen juniors go up 500% in 2 weeks. Almost nobody cares about that. If we're rational about it, in reality, especially if it's a good team, it's a good mine, we think they can pull it off. Man, I mean, if we could compound at 200% per 2 years, insane. That would be better than this guy I talked about in the last video expecting 50% per year in Bitcoin, and he's all in. 200% over 2 years, that's disgustingly good. Especially if it's, high probability, etc. Disgustingly good. And let's be honest, there's a bunch of juniors that have the potential of going up 200% in 2 weeks. How many will actually do it? Extremely, extremely few. Can you know who will? No, you really can't. So it's almost a moot point, but that's why everybody kind of blows themselves up, because nobody cares about 200% returns in 2 years from just waiting, doing nothing. It's like for all to see. It's like it's in the presentation. We expect to have this mine up and running in 2 years. At that point, it should be doing this in cash flow. It's a good study, good people behind it. They're fully financed. Still, nobody freaking cares, and that's why it's considered to be alpha. Just buying on a build start and waiting 2 years. That's kind of been proven to be effective at like generating good returns, but nobody cares. That's why it's actually the ones who do care and can wait. That's why they make money on it. So they're playing. It's the arbitrage, or it's like paid to wait. Okay, I exchange being able to be bored for 2 years, knowing that it's very obvious positive news release. Whatever. It's like the commercial production. News release is going to come in 2 years. If that happens, I'm going to get 200%. If I can find more such stories, I'm going to be compounding at 200% on average every 2 years. And I'm going to make a lot of money. The trick is, of course, you don't know what the gold price is going to be in 2 years. If it's a non-proven management team, for example, or something else, or there's geopolitical or political situations, like there's never a guarantee, but it sure is. In its basic form, it makes sense. And I would say that's like, especially the more obvious the news release. I mean, the closer it gets into time, it kind of, this shouldn't even be tapering off. It should almost go exponential like this. There's nothing more appealing to the average investor or speculator than an imminent news release that is expected to be positive. I think one perfect example of this right now is Emerita Resources. The idea now is that there's a project in a legal battle, and there's some court ruling or something. So that's happening in the not too distant future. So the narrative is that they're gonna get a project. It's gonna happen soon. And when they get it, the stock is gonna go up 100%. That is the most enticing thing there is for a speculator. The idea of, I think I don't know what the odds are, but it's like, let's say you think it's like 90% they're gonna get it. If you think there's a 90% chance that you're gonna double your money on date X, and today it's 30 days from X, every single day that passes gets closer and closer and closer to the event where you think, well, I'm automatically gonna double my money. That is extremely appetizing, for obvious reasons, because at face value it makes total sense. I mean, the day before it's like, okay, tomorrow I'm gonna double my money. How much money would I want to have in that doubles? An infinite amount, we kind of saw that. I think similar thing happened here. I mean, here it just went absolutely exponential. Because again, what is the appetite to double your money on a news release that you know when it's gonna come? I mean, it's basically infinite appetite. So here, for example, in a sense, and we kind of saw a similar thing in, take Western Alaska, when they put out visuals of this hole has 100 meters of semi-massive to massive sulfides. The narrative is, the idea is, the feeling is that, well, okay, I know that hole is gonna be good. And in this case, it's not even a discovery hole. It's like you're getting a whole project. So you're skipping the discovery hole phase to proving it up. You're getting a whole asset. So it's even more impactful in a sense than a discovery, because you're both discovering and proving up a deposit in the same news release, or it's already a proven asset in a sense. So the oomph in expected in emo is even bigger, because it's not a discovery. It's like they're discovering and proving up a deposit in one news release if they get a whole project. You know what I mean? That's what can create these absolute vertical moves, because it's, in a sense, at face value, it feels like it's never too late to buy before the news release is out, because whatever price you're paying before it, you expect you expect to be able to sell it for a lot higher after. So it in that sense it doesn't really matter. If you assume that I'm going to be able to sell it the next day after the news release for 50% higher or 100% higher, whatever. So that's like crack to everyone. And in the case of Western Alaska, it ramped all the way because nobody knew when the assets were actually going to come out. So it was only a matter of like, okay, well, if you're in before, you're going to buy automatically make money because everybody, you are convinced and everybody else is convinced that the news release is going to be good. Problem is, everyone bought before the news release, and you had a shit ton of people that were just waiting to be able to sell. And now, I mean, in this case for emo, I mean, there's been quite some time since I saw a sentiment this hot in a stock. I've seen people talk about, this is going to be worth 7 billion, which is absolutely, in my opinion, crazy, given that Lundin Mining just sold 2 operating mines. One is the huge Neves Corvo mine I think it's in Spain or Portugal, and then Zinkgruvan in Sweden. Both are making money. Both have fully built mines already. They sold it for, they're selling it for $1.4 billion US. 2 fully built mines. What the asset they're getting might be better than one of them, whatever, but it's still not a built project, if you know what I mean. So it's like, I think the ones that are touting, $7 billion paydays, for example, that is quite wild. But it will get people to, again, think that it's never too late to buy. Because if you think that if they get this project, emo can be worth $7 billion, and when they're getting the project is soon and getting sooner every passing day. I mean, if you believe that has a very high chance of happening, then it's like, okay, I'm gonna get in people's heads in a sense. It's like, as soon as this news release comes out, I'm gonna get a 10-bagger. Every day that passes is one day closer to me getting a 10-bagger. Of course, that's very, very exciting. I think back here, I guess they didn't actually get the project. I don't know what happened here, but I remember I think it was the hottest stock in the entire space, and then it, I think, went down like 93% or something. So obviously things didn't pan out then. I don't know. I mean, what's going to happen now? It sounds like it's almost a guarantee, whatever. I have no idea if it is, and even if things go forward, I don't know how long it's going to take. But again, it's like a perfect example, at least, of this, where it's like, and you could be. I don't think it's been a secret that there was going to be a court date, for example. But it's like, let's say this court date was known. It's like that there was going to be a court date in whatever March or something. That this was already known 6 months ago, or not 6 months. Let's say 9 months ago or something. That would still make it too boring in a sense. But when it passes the point of caring, where it's like, okay, now it's starting to get imminent. It's like, I don't know, tripling my money in 9 months is like F that. Tripling my money in 6 months, 7 months is like, nah, heck, I can find a meme coin. Tripling my money in 4 weeks from now, heck yeah. 3 weeks from now, even better. 2 weeks from now, even better. I actually thought about buying because yeah, I mean, you, especially when it goes vertical like that, it's hard to. I mean, sentiment is going to feed on itself. I mean, if this stock was going the other way, you wouldn't be seeing people talking about $7 billion prices. But when it has momentum like that, going back to the Bitcoin guy, where it's like the the more it goes up, the more convinced you get about how much more it's gonna go up. That's also like, I mean, crack in a sense. So I have no idea how what's gonna play out in emo. I don't know the story well enough, but this is, I would say, a perfect example of this phenomena here, where it's like no, almost nobody cares, even if it's an expected positive news release, if it's X amount of months plus out. So again, if we, I don't know if that's the case, but let's say that this coming court thing was known for this entire time, whatever. So like this up and coming court is like that was pretty much set in stone back in 2023 already. So it's like you knew it was coming, but the stock and the market knew it was coming. Everybody knew it was coming, but it hit a low of 25.5 cents. And the simple reason being that everybody knew this news release was coming, but it was not imminent. So it wasn't priced in. And then the closer and closer and closer it gets, the more appealing it is, because the peak excitement is, of course, that you're gonna make a lot of money tomorrow. So that this phenomenon of, like, I mean, our impatience, and it's like everybody wants higher. When you believe you can make a lot of money in tomorrow or very soon, that's exponentially more appetizing than thinking you can make a lot of money, even more money, 9 months from now. 9 months from now. So I mean that's a pretty big thing, right? It's like, okay, you mean that again? I don't know what's gonna happen. Let's say Emeritus goes up 50% from here, over the next whatever court case thing over the next 3 months, which is I mean a huge return. But if you had the patience of buying it, no, with the same information, had the patience of buying, it's like, now I'm actually gonna buy it a year before this news release. In a sense, sure, you'll get 50% in 3 months, assuming that's gonna happen. That's absolutely great from a compounding, but it's like even lower risk in a sense of getting whatever, like 600% from just waiting a year on a known quantity. It's like a known positive news release, or it's like that everybody expects to be positive. Quite the difference, right? Lower price, lower risk. They have an asset already. Now it's obvious. I mean, more and more is getting priced in. It's like less upside, more downside potential, of course. So again, from a risk reward, it's like, yeah, if you only can find, I mean, this is quite unique in the sense there's like, okay, we're talking a whole project. But imagine if you could play almost any one of these angles alone. It's like, okay, optionality. Free optionality. Combine that with one, how the market can only price in one asset. It's like you would really want to have all three in one case. Free optionality, free upside risk, multiple projects, which basically means that the optionality is that much higher, let's say, or in the case of high risk, high reward cases that don't have marginal safety, you're at least skewing the risk reward extremely by having diversification to the upside and five juniors worth of upside in one junior and all that. So it's like this Any one of these are huge alone. This is enough, in the words of Pierre Lassonde, to make you a millionaire. Other cases, you can take advantage of this. And here we have what I think, for example, is a case where it's like one single news release, one single project. If you could be bored longer than other people, knowing it's like, yes, nobody cares about what happens in March 2025, in, whatever, early 2024. But you're like, okay, I'm going to wait a year, a full year. I'm not going to do anything, just waiting for this that everybody knows is going to happen, but nobody makes me pay up for, let's say. Because then fast forward a year and now we're seeing, this. If you can systematically put things like these and include them in your investing process, your strategy, that's huge. Absolutely huge. I hope. I hope I've been able to explain it somewhat well. I think it's gone long enough, so I'm not even going to go into the other ones. Well, some of these I actually covered, but I might cover them in another video and actually go through more. But yeah, so again, it's like the important thing is like how many people do you think actually thinks about these concepts? Or even it's like everybody knows the idea buy low, sell high. Everybody's heard it. Nobody actually does that. That alone, just playing the seasonality, the cyclicality, in a sector that's called a cyclical sector, almost nobody's even able to do that. So like when people say you can't make any money in juniors, I don't know what the fuck they're talking about. Because there's Mr. Market is leaving such huge opportunity gaps because it can't price optionality, it can't look at more than one thing at one time, and it's extremely impatient. And you have cases like, well, the ones I've said. And with that said, is there a guarantee that every single case you find some optionality or the market is missing, yada yada, or it's short time frame? No, I mean you have the sense where it's like, oh, you get free optionality, and let's say you paid fair value. There's no real margin of safety. You paid fair value. It's like a royalty by Franco-Nevada. Okay, they pay fair price for a royalty. They get all the upside for free. There is no upside. Okay, they don't make any money on it. They get their money back though, but on average, some are gonna pay off. I mean, their first royalty was that gold strike or whatever. So they had one that's like, oh, they found a 30 million ounce deposit or something. They didn't pay for a single ounce. That's enough. If they get one of, literally, they built a company from just one free optionality play that worked out. So it's not like, again, there are no guarantees in investing. We just want to skew the risk reward as much in our favor. Preferably, we want low risk, high reward cases. Because that, and in this case, for example, if we find a multi-asset, multi-target junior that's cheap and pricing in one, is that a guarantee that, oh, since the market is wrong here, or it's like it's offering too good of a risk reward, especially relative to many other juniors, is that a guarantee that you'll make money on it? No, because they can still miss on all 5 targets. Or extremely short time frame. Okay, if I think a news release is gonna happen in 9 months, nobody gives a shit about it. I'm gonna hold it for I'm buying it today. I'm gonna hold it for 9 months. It's not gonna do anything for the first 7 months or something. Is that a guarantee that it's gonna be up a lot in 9 months? Is that a guarantee that the thing you thought was coming, it's actually gonna come? No, things might change. There's 9 months worth of things happening in the world that might change things. Or maybe the sector crashes, or maybe there's a market crash, or maybe there's this and whatnot. A good strategy is not about guaranteeing anything. It's about skewing the risk reward. You don't need to be right on every single frigging story to make money in this sector, because as the as the saying is, it's like high risk, high reward, or let's say you can get away with like low risk, high reward, or low risk, decent award. It means that most of them are going to be asymmetrical bets. One story that, let's say, is 200% undervalued, that pays you off 200 to 500%. That pays for quite a few other juniors that didn't, that gets cut in half, for example. That's the idea. The worse your investing strategy is, the worse risk reward you get. I mean, I talked about this before. The worst thing is when you in practice deploy or employ, whatever you say, high risk, low reward cases. You own five, you own 5 juniors. Every single one is high risk, high reward. 1 in 5 work. You sell everything after a double. How is that portfolio gonna make any money? You simply, let's say, bad portfolio construction, maybe bad pricing, you came in when it wasn't even cheap, and when the reward side happens, that's supposed to be you have to ride it for it to have any chance of paying for the other ones. You end up selling everything after, whatever, sell 50% after it's up 50%, and then sell the rest of it once it up 100%. It's not going to pay for the 4 other stories that went down 60%, let's say. So that already, by definition, is going to be a losing portfolio. If you have a portfolio like that, just repeat it all over. 5 cases, boom, sell the one winner. There you lost money. Portfolio-wise, find new juniors, do the exact same thing. Boom, you're just torching money on fire. So it's not about guarantees. It's about good risk reward. If you can find low risk, high reward stories because you take advantage of stuff like this, you're gonna end up making money in the future. But it includes due diligence to figure out if there is margin of safety, and if there's optionality, and if that optionality can actually be worth anything, and it's not just useless optionality. It entails figuring out, okay, multi-asset junior, what's priced in, yada yada, and not just, oh, they have multiple assets, so I'm gonna buy this thinking that I made a super steal because the sum of its parts, but the parts will never get monetized, so it's a value sink, perpetual value sink potentially, or extremely short time frame. There's no guarantee, because if it involves time, well, every one of these stories every one of these tools, let's say, involves time, but it's like stuff might happen. You don't know how the market is gonna look or anything like that. But if you know what you're taking advantage of, if your case is, oh, nobody cares about this today, they will care in 7 months, or they probably will care in 7 months, I'm not paying up for it, so even if it doesn't happen, I still bought it cheap. Well, that's a pretty good risk reward scenario. You bought something cheap, might get exciting in 7 months, you're not paying for the excitement, you bought it and wait 7 months. Or one of these, oh, I'm paying for one project, I'm getting 5, any one of them might work, great, okay, makes perfect sense why that would be a buy. Optionality, okay, I'm buying something that's cheap and I get a shit ton of optionality for free. Yeah, common sense, that's cheap. Something that's free is cheap. So yeah, I mean, yeah, I hope you got something out of it. It's like, I mean, yeah, I mean, this is the stuff I actually like. I mean, I love the theory crafting of it all. Just trying to, I mean, the market is only human. The market is the marginal investor, and there's a lot of like institutions that are shit. And there's a lot of, I mean, yeah. It's like common sense. Make it simple. It's like we we should earn our returns. If we have, if you don't have a strategy, you don't know why you bought something. You just bought it, and it's like no idea about any of this, or it's like risk reward. Have no idea what that is. Like, why should you make money? You don't even have a strategy. You're much more likely to get abused by the market. Uh, Whatever that could be, like selling optionality, or you're the one selling and getting other people to buy optionality for free. Uh, you're the one that only can account for one project slash asset, while 4 or 5 of them have the threat of getting monetized. And I can buy those for free in that case. You're the one selling something so cheap because this expected positive news release is 7 months out, and you're gonna come in and buy back when it's 1 month away from it, and it's already up 50% because somebody started buying 2 months before the news release, and I can sell into you. So you have to decide: are you gonna take advantage of everyone else, or are you gonna be the one that's getting taken advantage of by the, let's say, the 5% that actually have a strategy at all? Yeah. Anyway, if I talked about any story, consider me biased. Don't see this as investing advice. I own shares of which did I talk? First Nordic, obviously, Inflection, Ridgeline, I think I talked about. I don't own shares of Emerita. Maybe I will one day, maybe I won't. I don't know. And since I don't own it, I'm biased against it. And believe me, I have no idea what's going to happen in Emerita. I just think it's the perfect example of, let's say, one or excitement that's imminent in a sense. Yeah. Anyway, thanks for listening. Again, it's like I'm not saying sell Emerita or emo. I don't know the story well enough. I can just observe that it's a very hot stock, and we can. I mean, I think I understand why it's a hot stock. Thanks for listening. Yeah, not investing advice. Don't invest money you cannot afford to lose. Yeah, that's about it, I think. Bye bye now.